It's no secret that unemployment rates have been on the rise lately. With so many people out of work, it's no wonder that the Federal Reserve is feeling the pressure to take action. That's right, experts are predicting that the Federal Reserve will be forced to cut rates by 2024. But what does this mean for you and me? Well, the truth is that it could have a huge impact on the economy as a whole, from housing prices to the stock market and beyond. The Federal Reserve, aka the Fed, recently indicated that they won't be raising interest rates anymore. This is because the economy is slowing down majorly, and a ton of people are getting laid off and becoming unemployed. Big companies like Charles Schwab and Qualcomm have done massive layoffs over the past couple of weeks. This has caused the unemployment rate to jump up fast, going from a low 3.4% earlier in the year to now sitting at 3.9%. The Federal Reserve sees all this craziness happening and realizes they have got to pump the brakes on interest rate hikes to try and stabilize things. The job market was looking real solid for a minute, but now it's getting shaky and folks are struggling to find work. The Federal Reserve wants to step in and be like, "Chill, we got you," to try and keep this situation from spinning out of control. They're paying close attention and adjusting their plans to account for the economic downturn and spike in unemployment. The current state of the commercial real estate market is experiencing significant volatility, causing concern for Jerome Powell. Office buildings, shopping malls, and other related properties are rapidly losing value nationwide. Companies are realizing they don't need fancy downtown spaces anymore now that people can just Zoom from home. Malls are starting to look abandoned. It's a crazy situation for people who own these kinds of properties. They spent big money expecting to make it back on rent, but now their assets are worth way less. Powell and the Federal Reserve have got to figure out how to deal with it before even more people start losing their shirts in commercial real estate. The whole market could take a turn for the worse if they don't get this under control. And before I reveal how many Americans are unemployed and about to be laid off, please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe is fuel for the algorithm that helps support this channel. Thank you. Now, back to what I was saying. It's looking kinda sketchy for the banks too right now. They lent tons of cash for commercial real estate loans. We're talking about nearly $3 trillion. They've got major exposure if those office buildings and malls start dropping in value. And as we've seen, commercial property values are tanking with businesses closing and people shopping online. Banks might have to foreclose on some buildings when the loans aren't being paid back. But with the lower property values, they'll get way less cash than they originally lent out. This could significantly disrupt the financial stability of banks to the extent that they may need to cease lending altogether, which would be detrimental for the whole economy. If it's harder for people and businesses to get loans for cars, houses, investments, etc., then money stops flowing and things grind to a halt. If this real estate situation spins out for the banks, we could see some dark days ahead. The primary piece of information Jerome Powell had prior to announcing the Federal Reserve's decision to halt the increase of interest rates was that he had previewed the November jobs report before it was made available to the public. This report revealed a tepid performance, indicating a significant slowdown in hiring across the U.S. in October, with employers adding only 150,000 jobs. That's only half of what they added the previous month. The unemployment rate also rose to 3.9%. Additionally, wage growth has slowed down. This employment data contributes to the mounting evidence that the economy was experiencing a slowdown during the autumn months. Moreover, there was an increase in the number of individuals seeking continuing unemployment benefits, reaching the highest level since April. So yeah, with the job market looking shaky, Powell knew rates shouldn't go up anymore. The Federal Reserve had to pump the brakes. It's pretty crazy how the head of the Federal Reserve gets the details before the rest of us, isn't it? But that's how he knew it was time to stop hiking rates. Powell saw where things were headed before the data dropped. Hopefully that gives you the tea on why Powell changed course after reviewing the November jobs report. The number of unemployed Americans has risen significantly, reaching 6.5 million people. This marks a worrying increase of nearly 1 million compared to the low point experienced in April. As the number of unemployed individuals continues to grow, it's a clear sign that the labor market is slowing down. This, in turn, raises concerns about the potential for a significant increase in the unemployment rate. If we examine historical patterns, we can see a connection between the Federal Reserve's interest rate policies and unemployment rates during economic downturns. Typically, in the past 10 recessions, there's been an approximately 8-month gap between the Federal Reserve pausing interest rate hikes in their hike cycle and the unemployment rate starting to rise. If we assume that August 2023 marked the end of the Federal Reserve's interest rate hikes, history suggests that we might be in for a challenging period by the spring of 2024. This historical context warns us that a significant increase in unemployment may be on the horizon. The economy is not doing well, evident from Charles Schwab, one of America's largest banks and brokerage firms, recently letting go of 2,000 employees. This accounts for about 5 to 6% of their workforce as they aim to reduce expenses. Charles Schwab, ranked as the 11th largest bank in the country, faced significant challenges earlier this year during the banking crisis. Their decision to lay off more employees at this point suggests they have concerns about the current economic situation. Perhaps they're uneasy that bank deposits have yet to bounce back from the sharp decline they experienced earlier this year. It's truly surprising to witness the widespread layoffs in various companies, ranging from 200 to even 1,000 or more employees. What's equally surprising is that many of these layoffs don't make it into mainstream news headlines. But you might be wondering why this matters, particularly when it comes to real estate. Well, let's connect the dots. Right now, the condition of the housing market in the United States is undeniable. Home sales have taken a significant hit, and mortgage applications are down as well. To add to this, home prices are once again showing a decline. The combination of falling prices and the increasing number of homes on the market occurs during autumn. It's crucial to note that all of this is happening while the unemployment rate remains relatively low. These factors create a complex situation in the real estate market that's worth understanding. We're on the brink of a potential crisis in the housing market, and here's why it's crucial to understand what's happening. There's a deep-rooted connection between the unemployment rate and the rate of mortgage defaults. This connection has played out consistently in our historical data. The pandemic shook the financial stability of many households, leading to a significant uptick in mortgage defaults. However, these defaults didn't automatically result in foreclosures. The main reason was the temporary relief put in place banning foreclosure, which temporarily protected homeowners from losing their properties. This period witnessed a welcome trend as the mortgage default and unemployment rates began to drop. But here's the latest concern. The unemployment rate, which had fallen to 3.5%, has now edged up to 3.9%. If this trend continues, we'll likely witness a corresponding increase in mortgage defaults. This is a serious issue because the housing market is not adequately prepared to handle a surge in defaults. The potential implications are significant. As more individuals face difficulty in meeting their mortgage payments, it will put a strain on the housing market considerably. It might lead to an oversupply of properties, which in turn could drive property prices down. Ultimately, this could have a ripple effect on the broader economy. Home prices are currently declining, even though mortgage defaults are at historically low levels. But here's the looming question. What happens if the mortgage default rate creeps back up to a more typical long-term range, like 5 to 5.5%? The answer is simple yet significant. We're likely to witness a surge in forced property sales. As we step into 2024, it's becoming increasingly likely that the Federal Reserve will come under mounting pressure to consider interest rate cuts. In fact, I believe we may even witness emergency rate cuts during the year. However, it's important to clarify that these emergency cuts won't necessarily bring interest rates plummeting from 5% down to 2% or 0%. Instead, what's more probable is a series of gradual reductions similar to what transpired in 2006 and 2007. Back then, the Federal Reserve maintained interest rates at around 5.3% for about a year before implementing incremental cuts, a move aimed at stabilizing the economy. It was only when circumstances took a severe turn for the worse in 2008 that they resorted to substantial rate cuts. This pattern also had similarities in 2000 during the dot-com bubble. It's crucial to recognize that when the Federal Reserve initiates rate cuts, it won't lead to an immediate drop in mortgage rates to 3 or 4%. Rather, the trajectory is likely to involve a more gradual adjustment. Mortgage rates might dip to around 7% initially, then perhaps down to 6.5%, or there's a possibility they may remain relatively high. According to betting markets, the Fed is projected to implement its first emergency rate cut in May of 2024. This would mark the start of a shift from the current rate range. This is a clear indicator that we're in a dire situation. Many individuals, whether active in the stock market or the housing market, are trying to reassure themselves that when the Federal Reserve eventually lowers interest rates, it'll act as a miraculous solution. However, history paints a different picture. The historical data suggests that once the Federal Reserve starts reducing interest rates, it's typically just a matter of a few months before a recession turns into a full-blown crisis. Thanks for watching, and please make sure you subscribe if you enjoyed the video and leave a comment below letting me know if you know people in your circle of influence that have been laid off. Thank you.